Picture the letter. It's from Social Security, and it says your Medicare premium is going up. Not by a few dollars, by $2, $3, sometimes $400 a month. You didn't change your coverage. You didn't do anything wrong. So why? Because of one good year you had 2 years ago, a year you've probably already forgotten. There's a name for that surcharge. It's called IRMAA. And once you see how it works, it stops being a gut feeling of dread in the mailbox and turns into something you can see coming and plan around. One honest thing first, because it matters. I'm not an accountant. I'm not an attorney. I'm not a financial advisor. Nothing here is tax or financial advice for your situation. Everything I mentioned today is an example to look into and take to a professional who knows your actual numbers. What I can do is explain a rule that catches a lot of careful, well-prepared retirees completely flat-footed. Calmly, in plain English, the way someone should have explained it to them long before that letter showed up. And here's the strange part. IRMAA only lands on people who did something right, people who saved, people who built up retirement accounts, or sold a home that went up in value, or finally had a good year. In a way, it's a tax on a successful retirement, and almost nobody warns you it's coming. So let's fix that. Let me tell you about a couple. I'll change their names and call them Walter and Diane. Walter is 70. Diane is 68. They live outside Asheville, North Carolina. Walter spent his career as a high school principal. Diane was a nurse. They're not wealthy people. They're careful people. The kind who paid off the house, kept a budget their whole lives, and put a little into a retirement account every single year for 40 years. A couple of years ago, they did something completely ordinary and completely smart. They had an old rental, a small house Walter inherited from his mother years back, and they finally sold it. After everything, it put a one-time gain on their tax return that year. Their accountant told them what they'd owe. They paid it, and they moved on. Good year. Smart move. Done. Except it wasn't done. Almost 2 years later, a letter showed up from Social Security. Because of their income, it said, Walter's Part B premium and his Part D drug premium were both going up. So were Diane's. Added together, across the two of them, it came to a few $100s a month they hadn't budgeted for, more than $3,000 over the year. Walter read it 3 times. He hadn't touched his Medicare. He wasn't earning more. These days his income was just a pension and Social Security. So why was his premium suddenly hundreds of dollars higher? Here's the answer. The letter wasn't about this year at all. It was about the year they sold that house 2 years earlier. And nowhere in that whole sale had anyone mentioned that the gain would reach forward 2 years and raise their Medicare premiums. That's IRMAA. And the thing I most want you to hear is this. What happened to Walter and Diane was completely predictable, if you know the rule. So, let's learn it. IRMAA stands for the Income-Related Monthly Adjustment Amount. Say it slowly and it explains itself. It's an adjustment, an extra amount, added to your monthly Medicare premium based on your income. That's the whole idea. A surcharge on top of the normal premium for people whose income is above a certain line. Here's how Medicare premiums normally work. Most people pay nothing for Part A, that's hospital coverage, and you prepaid for it through payroll taxes during your working years. Part B is different. It covers doctors and outpatient care, and it has a monthly premium. As of 2025, the standard Part B premium is around $185 a month, and it creeps up most years, so check the current figure. Most people on Medicare pay exactly that. It comes straight out of your Social Security check before you ever see it. But if your income is over the threshold, you don't pay the standard premium. You pay the standard premium plus IRMAA. And IRMAA hits 2 things, your Part B and your Part D, your prescription drug plan. Both get a surcharge. So a higher income retiree can be paying the standard amount, plus an extra on the doctor side, plus an extra on the drug side every single month. And one detail trips everybody up. IRMAA is per person, not per household. If you're married, you're both on Medicare, and your joint income is over the line, you each pay your own surcharge. Walter paid his. Diane paid hers. That's why their 2 letters added up to real money. Now, here's the single most important thing to understand about IRMAA. The thing that turns it from an ambush into something you can see coming. It's based on your income from 2 years ago. Think about why. Social Security doesn't have this year's tax return yet. You haven't even filed it. So to set your premium for this year, they reach back to the most recent return they do have. The one from 2 years earlier. So your 2026 premium is based on your 2024 return. Your 2025 premium came from your 2023 return. There's always a 2-year gap between the income that causes IRMAA and the bill that reflects it. That gap is exactly why it blindsides people. The year you have the big event, you sell the house, you do the Roth conversion, you take the large withdrawal. Your premium doesn't move at all. Everything looks fine. You might even forget it happened. Then, 2 years later, with no warning and no obvious connection, the premium jumps. Cause and effect sit so far apart that most people never link them. Walter had a good year selling that rental, life went on, and 20-some months later, the bill for it finally landed. The number they look at has a name too. It's your Modified Adjusted Gross Income, MAGI. Don't worry about the math tonight, just know it's basically your adjusted gross income from your tax return, plus a couple of things added back in, like tax-exempt interest. The point is what it counts, and MAGI counts almost everything. The taxable part of a home sale, a Roth conversion, capital gains, IRA withdrawals, pension income, the taxable part of Social Security, interest, dividends, all of it added together. That one number from 2 years ago decides which side of the line you land on. Here's the one feature of IRMAA that costs people the most and makes them the angriest when they find out. Because it doesn't work the way most taxes work. You know how normal tax brackets go. You inch over a line, and only the part above the line gets taxed more, gentle, forgiving. IRMAA isn't like that. IRMAA is a cliff. $1 over a threshold and the entire surcharge applies. The whole thing for the whole year, not just the dollar. The whole thing. There's no easing in. A single dollar of income can be the difference between paying the standard premium and paying hundreds of dollars more. Let me put real, round numbers on it. And please treat these as about this, as of 2025. Check the current figures, because the thresholds move every year. As of 2025, a single person with income up to around $106,000 pays no surcharge. For a married couple filing jointly, that line sits around $212,000. Stay under, and you pay the standard premium. Go $1 over, and you're in the first IRMAA tier, which, as of 2025, adds roughly $70-some a month to Part B, plus a smaller bump on Part D. From there, the tiers keep climbing. The surcharge grows at every step, all the way up to the top tier, which, as of 2025, starts around $500,000 of income for a single person and $750,000 for a couple. At the top, you're looking at something like $440 a month on Part B alone, on top of the standard premium plus the Part D surcharge. So picture two retirees, nearly identical. One has MAGI $1 under a threshold, the other $1 over. Same lifestyle, basically the same income, and one of them pays hundreds of dollars more for Medicare that year over a single dollar. That's the cliff. The first time you hear it, it feels unfair, and frankly, it kind of is. But here's the flip side, and it's the good one. A hard line is a line you can see, and a line you can see is a line you can plan around, which is what the rest of this video is about. So what actually pushes an ordinary, careful retiree over one of these lines? Almost always, it's a one-time event, not your regular income. Your pension and Social Security usually sit in a steady, predictable spot. It's the one-year spike that bumps you up a tier. Let me walk you through the most common ones, because if you can see one coming, you have time to plan. The first, and probably the most common, selling a property, a home, a rental, a piece of land. If the gain is big enough, especially on a rental or a second property where the large primary home exclusion may not fully apply. That one-time gain lands on that year's return and pushes your MAGI way up for that single year. That's exactly what happened to Walter and Diane. The second is a Roth conversion. Moving money from a traditional IRA into a Roth is often a genuinely smart, long-term play. But the amount you convert counts as income the year you do it. Convert a big chunk in 1 year, and you can sail right past a threshold without noticing. Third, large capital gains, selling appreciated stock, a fund, a business interest. Fourth, a big IRA or 401k withdrawal, maybe to buy a car, help a grandchild, cover a major repair. Fifth, required minimum distributions themselves. Once you hit the age where the government makes you start withdrawing from retirement accounts, those withdrawals are income, and for people with large balances, they can be big enough to matter. Sixth, a pension lump sum, or cashing in an annuity or a life insurance policy. And there's a seventh that's quieter and sadder, and I want to say it gently, because it catches people at the worst possible time. When one spouse passes away, the survivor usually files the next year as a single person. Remember those thresholds? The single limit is half the married one. So the same income that sat comfortably under the married line can suddenly land over the single line. A widow or widower can get an IRMAA letter the year after losing their spouse, on the same income they always had, simply because the threshold for them was cut in half. If that's you, or someone you love, please hear two things. It's a known situation. And as you're about to see, it's exactly the kind of thing you can appeal. After all that, I need to make sure you leave with the calm part, because for your peace of mind, this is the part that matters most. IRMAA is not permanent. It's recalculated every single year. It doesn't follow you for life. It's a year-by-year adjustment based on a moving 2-year-old snapshot of your income. So if Walter and Diane's big income was just that 1 year they sold the rental, their MAGI goes back to normal the next year, and about 2 years after that, their premium drops right back to the standard amount on its own. They don't have to do a thing. The surcharge was tied to one unusual year, and once that year rolls out of the 2-year window, it rolls off the premium too. So if a letter shows up because of a one-time event, take a breath. In most cases, it's temporary, a 1 or 2-year bump, not a life sentence. Just knowing that takes most of the sting out of the envelope. But what if the increase isn't fair in the first place? Because your income has already dropped. This is the part almost nobody knows about, and it's the most useful thing in the whole video, so stay with me. Remember the 2-year look back. It uses old income. But what if something changed since then that permanently lowered what you earn? The clearest example, you retired. 2 years ago you were still working, drawing a full salary. Now you're retired, living on a pension and Social Security, a lot less. Charging you a high-income surcharge based on a salary you no longer earn would be genuinely unfair. And Social Security agrees. There's a form for exactly this. It's Form SSA 444, Medicare Income Related Monthly Adjustment Amount, Life-Changing Event. If you've had a qualifying life-changing event, you file it and ask Social Security to recalculate your IRMAA using your current, lower income instead of the 2-year-old number. What counts as a life-changing event? The official list includes things like this: you stopped working or cut your hours, retirement counts, the death of a spouse, marriage, divorce or annulment, the loss of a pension, and a few others. That covers a lot of what we just talked through, including the widow or widower from a minute ago. If your income today is genuinely lower than the 2-year-old figure on file, and a life event caused it, the SSA 44 is how you tell them. You fill it out, attach proof, a letter showing you retired, a benefit statement, and send it in. People win these reconsiderations all the time. It is not a loophole. It's the official, built-in correction for exactly this situation, and it's free to file. One thing, though, don't ignore the letter. The increase doesn't undo itself just because it feels wrong. If you don't think it should apply to you, the SSA 44 is the calm, correct first step, and it's worth doing. So let's pull this into the part you can actually act on. Maybe you're not in one of these situations yet, but you can see a big income year coming. A home sale, a Roth conversion, the age when withdrawals start. Here's the kind of thing careful retirees do, with a professional, to keep IRMAA from catching them. Same disclaimer as always, these are examples to talk through with someone who knows your full picture. Not advice for your specific case. First idea. Just know where the lines are before December 31st. Most of these income events run on a schedule you control. If you're doing a Roth conversion or selling something, your tax professional can tell you roughly where your MAGI will land, and whether you're about to clear a threshold by a little or by a lot. Sometimes the fix is small. Move part of the income into January into the next tax year so 1 year doesn't spike. Second, spread things out. Instead of one enormous Roth conversion that vaults you up 2 tiers in a single year, some people convert smaller amounts across several years, staying under a threshold each time. Same idea with selling investments. Realizing gains in measured pieces instead of all at once. Third is a tool we actually mentioned back in the episode on overpaid bills, the Qualified Charitable Distribution, or QCD. If you're at the age for required withdrawals and you give to charity anyway, sending the money straight from your IRA to the charity can satisfy that required withdrawal, without the money landing in your MAGI. It's one of the few moves that lowers the very number IRMAA looks at, again, for the right person with a professional. And the fourth is the one Walter and Diane learned the hard way. When a big one-time event is simply unavoidable, you're selling the rental, that's that. Just know the IRMAA bump is coming. Budget for it as part of the cost of the decision. And remember, it's temporary. The goal was never to dodge every dollar of surcharge. The goal is to never be blindsided again. A bump you planned for is a completely different experience from a letter that makes no sense. So here's the whole thing in one breath. IRMAA is a surcharge on your Medicare Part B and Part D premiums when your income is over the line. It's based on your tax return from 2 years ago. That's why it surprises people. It's a cliff. $1 over a threshold moves you to the full next tier. The usual cause is a one-time income event, a property sale, a Roth conversion, big gains or withdrawals, or, for a survivor, simply being moved to the single thresholds. The good news, it recalculates every year, so a one-time bump is usually temporary. And if a life-changing event like retirement lowered your income, Form SSA 44 lets you ask Social Security to use your current income instead. Know the lines. Plan the big years. And never let the letter be a mystery again. Here's what I'd leave you with. IRMAA isn't a trap, and it isn't a punishment. It's just a rule. Almost nobody bothers to explain until after it's bitten you. But now you've seen it coming. You know it looks back 2 years. You know it's a cliff. You know the events that set it off, and you know the one form that can fix it when it's wrong. That turns a scary envelope into a manageable line item, which is the whole idea around here. If this helped, do one kind thing with it, send it to one person who's near retirement or already in it, especially anyone who just sold a property or lost a spouse. This is exactly the kind of thing that should get passed along before the letter shows up, not after. In the next video, we'll stay right here in this calm corner of retirement planning and talk about the required withdrawals that catch people off guard, what they are, when they start, and how to keep them from quietly pushing your income and your Medicare premium higher than they need to be. I'm Daniel Brooks. This is Money Desk, where we make your money easy to explain. Take care of yourself, and I'll see you in the next one.